Good morning. Welcome to Market Monday. All right, it's happening. Just as we've been talking about for the past few weeks, the market is right on schedule with its late September sell-off. Wait a minute.
Not how you say
it. Ah, that's better. You hear the noise out there too, don't you? That's what we have to do. Turn down the noise. We've been talking about it for the past month, and it's only recently begun happening. The late September swoon.
That's right, which we've been talking about ad nauseum for this very reason, for this moment when the market sells off over 5%, the chatter picks up and the noise drowns out our sensibilities. But we've expected it, haven't we? It's almost eerie how closely this pre-election year has been tracking its seasonality. These are pre-election years like we're in now. Strong start to the year, check. Pause, pullback, flat, meandering, grinding, not just through October, even through November. Then a strong finish to the year. You can see March through June didn't map exactly to prior years, but the general theme was alive and well, and it eventually got there.
Here we are right here. Some of the toughest weeks of the year. If we're following this every week, which we'd recommend you to leave to us, but if you do, and we get a bit of relief, then back down as we get through October. Don't panic. This would totally be normal market behavior. What else would that mean? When markets sell off, what else happens? Future returns are higher. We all love to see green and gains. We do. But while that feels good in the moment, that also means we've captured some of those future gains. And they're now in the past. So when markets go down, that also means future returns are higher.
It's a great point. That could mean years into the future or just months into the future. Here's a look at the returns in the S&P 500 stock market during each of the last 4 Septembers, including this year through the 26th. But you knew that, right? You expected that because we've been saying this ad nauseum for the past month or two.
And here's a look at the corresponding fourth quarter returns for each of those years. No guarantees, just history and context. But to my earlier point, could down markets in September help set up higher future returns, even a few months later?
Of course, this is for the S&P 500 stock market, the most indexed stock market, probably on planet Earth. But the S&P 500 isn't the entire stock market, not even close. It's about 500 large stocks based in the US. And the bigger the company, the larger the weighting it has. So Apple may have around 7 or 8% weighting, give or take. And the 50th largest company, that's currently Philip Morris, has just a 0.4% weighting. Halfway down at number 250 is Republic Services, which provides waste and recycling services, is at just 0.08%. So you can see the largest of the large companies are really what your exposure is in the S&P 500. But did you know there's another S&P 500? One that takes all 500 companies and gives them an equal weighting. So Apple and Philip Morris and Republic Services all have the same effect on the index. It's interesting to look at equal weight indexes because it shows us how well or how poorly the average stock is doing.
And in fact, here's how that equal weighting index is doing. Traditional S&P 500, as you see it in the media, up about 11% for the year. Equal weighted, flat. So what gives? Bam, you guessed it. The so-called Magnificent Seven, the top 7 stocks in the S&P 500, are up about 81% for the year. You heard that right. Probably linked to the AI revolution, as Magnificent Seven stocks are Facebook Meta, Apple, Amazon, Google Alphabet, Microsoft, Nvidia, and Tesla.
Clearly, the S&P 500 isn't the entire US stock market, and the US stock market also isn't the entire global stock market. We see here the US stock markets represent about 42% of global stock markets. We have Canada over here at 2.7%, the EU and UK at about 14% combined, China at about 10%, Japan 5.5%, and other emerging markets at about 9%. Yes, China is still considered an emerging market. So this would be countries like Indonesia, Vietnam, probably India. So even though the US has dominated stock market performance for the past decade, it hasn't always been that way, and don't expect it to be that way forever. We would argue, despite recent underperformance, it is still reasonable and prudent to have some of your stock exposure to other global markets.
So here we are at about 7% pullback from the July peak. That's this one right here. Looking back since the October low, we've been here before. Right here was into mid-March, that was a 7.8% pullback. And again, late last year, December 28th, a 7.3% pullback. Folks, these pullbacks are right on schedule, are totally normal, are features of investing, are what allows our long-term higher returns than risk-free investments. So please, whatever the next few weeks bring, tune out the noise. And we'll be here with you every step of the way. Have a great week.